Hi, I'm Toby.
And I'm Nick.
And welcome to the Pure Property Podcast from Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you bite-sized chunks of our industry insight and knowledge to help investors invest intelligently. Now, before we go into what we're going to be speaking about today, I thought it would be good to have a brief talk about the latest Hometrack report that we've had, which is referenced to April 2021. So we've had the data and we've had the findings in, and again, very positive, very good. Definitely a stark contrast in comparison to what people were forecasting end of last year and beginning of this year. So that is good. Now, I won't go into too much detail, but as usual, we'll put a link in the show notes so you can review the full report for yourself. I think the main thing to look at, which is really good to see, the actual sales completions forecast has gone up to reach 1.5 million this year. That's up from 1.04 million last year, and is actually the highest level since 2007. So very, very impressive, especially in the midst of a pandemic. The value of sales in 2021 is now forecast to be £461 billion. That is up 68% from 2019. And that is due to a rise in higher value homes exchanging. Total stock of houses and property for sale still remains constrained. That's down 20.8% in the year to mid-May compared to the average last year. So again, we've got constrained supply, we've got elevated demand, hence why what we've seen in this report, annual UK house price inflation is at plus 4.1%. So very, very strong house price growth there across the UK as an average. That's up from 2.3% in April last year. Now, just looking at the front runners in capital growth aspects, you've got Liverpool are now top of the capital growth table. So they're coming in at 6.9%. Manchester second with 6.8%. Nottingham third, 5.6%, and Leeds fourth in 5.5%. Now, the top four there haven't changed. The only thing that has changed is Liverpool and Manchester have shifted. So they're the top four. Great capital growth there. And the real interesting thing, which I think is good for a lot of investors we're talking to at the moment that are considering Liverpool, is when we look at the average price for Liverpool in comparison to the rest of the top four. Liverpool was sitting at £132,000, Manchester 187, Nottingham 170, and Leeds 180. So there's quite a big gap there with the average price in Liverpool, which just shows that there should be room for a lot more growth there for them to catch up and meet the other top three as well. So that's exciting to see also. But yeah, that's enough of the Hometrack House Price Index report for April. Please feel free to check it out using the link in the show notes. I definitely recommend it because it's good to see what the market's doing. It also has a market outlook, etc., etc. So there's a lot to look through, which can help you when determining maybe where you want to invest, when you want to invest, etc. So definitely check that out.
Good stuff. Yep. Quick recap of the market there, really giving an indication to where we are. A lot of data and a lot of figures obviously mentioned by Toby, but the long and short of it is it's still exceptionally busy. Demand is through the roof at the moment, both from the new build and the secondary market. And you're still seeing the main characters in terms of the best performing cities. So your Liverpools, your Manchesters, etc. So as well, the only other point I wanted to add is on Liverpool, as well as there being that significant room for growth and appreciation in comparison to those other top runners, it also makes it a great investment entry level location. So people that have got one or two properties looking at Liverpool, is certainly a great opportunity for both growth and to keep that initial capital outlay really low as well. So yeah, exciting stuff ahead. So today we're going to be speaking through different property investment types. Now, by that, we can refer to it as different types of strategy, different routes to market, different ways you can effectively spend your capital and make money through property. So we're going to be running through a few of these strategies, and a lot of them you would have heard of before, but hopefully we'll provide a bit of detail to really shed some light on it. So we'll look at the different types of properties, strategies, the pros and cons, and then look at ultimately who they might suit, so you can potentially weigh it up against your characteristics as an investor, your risk profile, your time frames, etc, etc. So we're going to kick off with the first one right now. So Toby, if you want to lead us into it.
Yeah, the first one we're going to start with is HMOs. So these are houses of multiple occupancy. So this is a house where the rooms are rented out individually to unrelated tenants. So effectively, it's a house share. So rather than rent it out as a single dwelling, you rent it out room by room. So HMOs, they tend to generate higher rental income and yields, and this is because obviously you are renting out room by room. So for example, you can turn a 3-bedroom house that rents for £750 per calendar month into a 4-bedroom HMO. So you could convert maybe the living room into another bedroom. That will rent out room by room for around £350 per calendar month per room, which then equates to £1,400 per calendar month. So that's an extra £650 per calendar month. So you can see how the rental yields are increased. Now, they do also come with higher costs as well, as they tend to be let furnished and with bills included. So they also usually have more wear and tear. Management is more time consuming, which usually then means higher lettings fees, or the landlord needing to be more hands-on. So, in short there, the costs tend to be higher. However, even with the added costs, they do usually yield better than a standard buy-to-let. Obviously, take into consideration that you need the rooms to be let and full as well. Regulations are also tightening up, so that is something to consider. Some HMOs need licenses, and in some areas, councils do not even allow them due to market saturation, etc. In some areas, there is what is called an Article 4, which is where you need to seek planning permission to change a property's use from a single dwelling use to a HMO. Now, the pros of a HMO is higher yields than single buy-to-lets. Your risk is kind of spread as well because you've got multiple tenants. So if one stops paying you, at least you've got the other in the property that are paying you as well. So you do spread risk. The cons of HMOs, they are labour intensive, very time consuming. Lots of regulations to comply with. As I mentioned, you've got licensing in some councils, sort of coming down on them, regulations, etc, etc. You have to have fire safety, etc, etc. So there's a lot to consider. The other con, as I just mentioned, some do need licenses, so this can cost money, and that does vary from cities and towns and councils. There's not just one price. Different councils do charge different prices for licenses. And also mortgages are slightly harder to get on HMOs as well. So that is, again, something to consider. Now, what type of investor would a HMO fit? Now, in our opinion, they're going to be more suited to an experienced investor, one that has time, and one that is very good at running numbers, because you do need to get your numbers right. And when we say experienced, it's because you do need to pick good locations for HMOs. I mean, student towns are very good, city centre locations, etc, where the tenant demographic might suit these. So yeah, you do have to have good experience, and we don't really recommend them for the novice, just because there's a lot involved. There is a lot that can go wrong, and yeah, running numbers is especially very, very important when looking at HMO. So Nick, why don't you take us on to the next property investment type?
Good stuff. So going back to something I think we discussed a couple of weeks back, this would be serviced accommodation or short-term lets, sometimes referred to as holiday lets, all effectively the same thing. Ultimately, you're renting your property on a short-term basis. So these are normally fully furnished apartments or holiday type properties which are available for mostly short-term stays, also longer-term stays as well. It's similar or comparable to what you'd expect to see in a hotel, but often with self-catering facilities as well. So all the essentials you need in the kitchen, etc., etc. So that you'll often find them advertised on Airbnb and Booking.com. You know, if you're going to visit Manchester, Liverpool on business, visiting friends at university, going for leisure and entertainment events when things open back up, there'll all be purposes as to why someone would travel and use a short-term let property. So it can be incredibly lucrative as a model. In some cases, I've seen examples of live developments where people are achieving over double of the rental yield you would in comparison to a traditional AST agreement, i.e. a long-term tenant. But you've got to make sure you're buying in a place where the occupancy rates are attractive and the cost per night is attractive as well. So in my opinion, there is a bit more due diligence required in terms of the market demand, because it is a bit more of a niche. However, if you get it right, there's certainly big rewards to be made. Now, it is similar to HMOs in terms of the labour intensiveness of running a serviced accommodation apartment is higher than a normal traditional AST. Obviously, you're going to have management companies that will do that for you, but it is something that you have to bear in mind. You might get a few calls here and there, and you might have to pay a touch more for the management service as well. But I'll go straight into the key advantages and disadvantages now. So hopefully our listeners can weigh up the pros and cons and ultimately make an informed decision. So first one, which I've already touched on, is they are very high yielding. So by high yielding, we mean when you compare the rental return in comparison to a traditional AST, they're significantly higher. So we often see short-term let developments achieving 8, 9, 10% net, whereas a traditional AST might achieve 4, 5, 6% net across Liverpool and Manchester. So that's based on the purchase price. So going back to basics here, if you buy a property for £100,000 and you earn £6,000 a year, that means your rental yield is 6%. We'll forget charges, but for now, just assume it's a gross yield of 6%. So if you're doing it on a short-term let model and you get 8%, for example, that means you're achieving £8,000 a year. So it's an additional £2,000 in your pocket. Obviously, there are more costs to consider, but even when you break down the fluctuating occupancy rate and the costs, etc., it's still far more profitable in most city centre cases than a traditional AST agreement. There's also no long-term contracts with tenants, or tenancy agreements, should I say. So it's not the case where once you get someone in, they're very hard to evict. They might be late paying rent, etc. You haven't got to wait a year to get them out. It's a very high turnover, fast-paced model. Does mean you get a little bit more wear and tear on the property, but it does allow for more flexibility in terms of who's coming and going. There are some tax benefits as well. I won't go into too much detail now, but if you Google serviced accommodation tax benefits, there are opportunities to further enhance your profits on the model by some clever planning. Okay, so that's the pros, and I think one other pro I'd probably just chuck in as a final point would be that if you are able to get a new build development which has short let approval, because ultimately if you're buying an apartment, it does need the approval in a lease to operate and to run this short-term let model that we're discussing today. If you can get a development that has that, it's important for yourself because obviously you have the flexibility to operate a short-term let model if you want and achieve a higher income. But also when you come to sell the property, it's more than likely, if it's 5, 10, 15 years, whenever it is, it's more than likely you're going to be selling to another investor. Now, the next investor, they're going to want to see high rental yields and they're going to potentially want the opportunity to operate a short-term let model. So if you can show high yields of 8, 9% that you've achieved and you've got this formal short let approval in the lease, that's really going to differentiate your property from hundreds of others on the market just achieving 5.5% net return. So yeah, there's plenty of advantages to serviced accommodation, and it's something as a company that we're very fond of. Okay, so let's move on to some of the disadvantages or some of the bits and bobs that you do need to think about. So firstly, as I touched on earlier, it does require a lot more work. If you think about it, if you're operating a short-term let property, you've got to advertise the properties, you've got to fluctuate the prices subject to events and what's happening in the city, subject to weekdays versus weekends, etc., etc. You've got to make sure your photos are obviously up to date and ready to go. When the tenant comes, or the guest or visitor, whatever you want to call them, when they arrive at the property, you've got to check them in, you've got to handle deposits, you've got to make sure keys are okay, you've got to make sure all the utensils and additional material that you provide is got to be there. And then when they check out, obviously you've got to make sure there's no damage and it's all clean and ready for the next tenant. So it's quite intensive in terms of the actual turnaround process. However, if you've got a decent management company, that should all be very streamlined and they should know exactly what they're doing to both minimize costs and time input. Now, with regards to a further disadvantage, potentially, it would be the fact that there are higher costs involved. So you will have to consider things such as utility bills, the main ones, Wi-Fi, etc. Some bits and bobs that you may leave to the tenant to do in a normal 12-month tenancy. If you're doing a short-term let model, as the landlord, you will have to cover that because obviously people are coming and going quickly and they need everything, fast, make sure it's working, and they don't want to have to, worry about extra payments, etc., etc. So, yeah, those first two, obviously a bit more labour intensive, potential higher costs, and then from the investor side as well, the other point you'd have to think about is that mortgages can be a bit more limited. So your range of mortgage products may be a bit more restricted, and you may find that there are potential higher interest rates or different mortgage terms that you have to consider. It doesn't mean it completely limits the market, and it doesn't take this model off the table for most people, but it is something that you do need to think about and just make sure you've done your numbers and you're 100% confident. So in terms of who this model would suit, we get a lot of investors that are very income focused and focused on the cash flow. They're not that fussed on playing the market and chasing the best appreciation. They just want hard money in their account every month. And if that is the case, serviced accommodation can be a fantastic model. It really will almost double your rental income and your cash flow in some cases. As I say, you don't have to be, Mr. Sophisticated Investor. Entry-level investors, those with one or two properties, can certainly operate the model as well. It's just all about getting a good partner in that managing agent. Something that we do at Track Capital is, really look at who we're working with, who we're recommending our investors to in terms of the management company, because it's so important. If you get a good one, they can maximize the income from the property and minimize your stress. If you get a bad one, they can maximize your stress and minimize your income in the worst case scenario. So it's really something you've got to be careful on. But if you do pick a good one, you do your research and find a good team, hopefully they'll help you over the long term and make sure it all runs smoothly for you. But as long as you've got a good company in place, you should be absolutely fine. I think that's it for the serviced accommodation and the short-term let aspect. If anyone does want to run through the numbers or look at, what are the extra costs and the pros and cons in a bit more detail, feel free to let us know. But I think, Toby, if you jump onto the next one now, and we'll go from there.
Yeah, next one we're going to look at is flipping. So flipping is effectively where you buy a property that needs work or that you can add value. You do the work or you add the value, that might be extending, etc., etc., and then you sell it for a profit. So rather than property investment, it's more like property trading. You need to have a good power team in place for this type of investment, or be in the building trade yourself, etc., or maybe be able to do the work yourself. That is a very important role because especially when it comes to costing and project managing. So yeah, that's probably one of the things you do definitely have to consider. The strategy of flipping, it's a good way to generate lumps of cash quicker. So rather than the drip-fed in income you get from a rental property on a monthly basis, this all comes in at once in a lump sum. So it can be very, very good for that. Now, it is important that you buy the property at the right price and that you are able to estimate your costs for the works, etc., very, very carefully. So that is an important factor when considering flipping as a strategy. You need to be excellent at number crunching, and this strategy can be quite risky and costly. It takes one mistake, one bad contractor, one figure out of place, and it could cost you quite a lot. And rather than a profit, you might not make as much profit, might break even, you might even lose money. And again, you have to pick the right property, right area to make sure you're able to get that resale value. So you do need to know what you're doing when looking at flipping. And I know I mentioned the power team, but I think that's quite important when sort of looking at this type of project, especially if you're not doing the work yourself when you're having to hire people in. So you do have to be very organized for this. As I mentioned, project management, when you've got different contractors coming in, you might have a bricklayer, then you've got a carpenter, then you've got a gas engineer, you've got a bathroom fitter, you've got all different sort of cogs that are involved in the mechanism of flipping a property. And yeah, that is quite important to have the project manager aspect on your side, because it is very important to manage those aspects of this strategy. Now, the pros of flipping is that you gain lump sums of cash very quickly. So that is one of the main pros for that. You also don't have any long-term maintenance of the property because you're buying it, doing it up and sell it on. You don't have to see it again. And then also, you don't have to deal with tenants. So again, once it's done, it's gone. You don't hear from it ever again. So there's no tenants to deal with. And then you don't have to really worry about the long-term performance of the property market because you're not holding it for a long term. You only need to really know about the here and now while you're doing the work. Now don't get me wrong. If you are doing a project of a flip which is going to take a year to 18 months, then you might have a slight concern about the property market and make sure you're on top of things because it can change in that time frame. However, it's not very likely. So yeah, another pro is you don't have to worry about the long-term performance of the property market. Now onto the cons. Usually you need a large amount of cash to start. So you do need that good financial backing for flipping. So again, really, if you want to sort of elaborate the profit as much as possible, you do need to be looking at properties which need a hell of a lot of work. And usually they will be properties that are unmortgageable, or you might have to go to an auction. So you need that cash sitting there to be able to buy those properties. Again, don't get me wrong. You can buy properties with mortgages that need flipping, but the profit margin may not be as big. But yeah, as I said, you can do that. The other another con, no residual income. So one of the main benefits of buy-to-lets is you have that residual income month on month, which is an excellent benefit. And you don't get that with flipping. It's you get your lump sum, then on to the next one, or you got your lump sum and then it's done. So no residual income. Another con, they are very hands-on and they involve a lot of project managing, as I mentioned previously. They are very time consuming, so you do have to bear in mind if you're a busy person, busy lifestyle, you don't have that much spare time, flipping is going to be very difficult for you. Not impossible, but very difficult, and it can be very stressful. As I said, you're dealing with different contractors, etc. It can be very stressful, so just bear that in mind. Another con is if you get it wrong, it can lead to selling at a loss. So again, do bear that in mind. But they're the main cons. What type of investor would this strategy suit? Now, in our opinion, it's going to be someone that isn't too fussed about passive income or residual income, and they want lump sums of cash. They need to have property experience of some sort, not necessarily property investing, but I think property experience, and they need to be very good at numbers. They need to be either good at doing some sort of building work themselves or have a very good power team in place. Now, what do we mean by power team? Contractors, solicitors, brokers, these are all part of your power team, but mainly for this one, it's going to be your contractors. So having those people that can go in, do the work, do it efficiently, you can trust the finish, and you can get it done all on time and all done on budget as well. That's very important. And yeah, you also have to be, as I mentioned, good at project managing. So somebody very organised, flipping is going to be good for. But that's the type of investor it would suit. Nick, why don't you go on to the next one we're going to talk about, the next strategy?
Certainly will, and I probably should have said earlier, but we are doing a part 2 of this episode next week. So I'm going to finish off with one now, and then next week we've got 4 more strategies that may be of interest to you as well. So be sure to tune into that. But the next one today is the purpose-built student accommodation market. So sometimes what we refer to as PBSA, or what everyone refers to as student accommodation. So these are these modern, flashy, normally large buildings that you've seen pop up in the past, 10, 15 years in key university cities across the UK. I'd say most, even, small to medium-sized cities now have some form of purpose-built student accommodation development. It's just been incredibly, incredibly popular as a model. Now, when we say purpose-built student accommodation, it's literally what it says on the tin. So developers, normally quite large-scale developers, are building these schemes with the sole purpose of renting to students. So no, mortgage buyers, residential buyers, etc., etc. It's all purposely built to rent to students. Now, the idea is obviously it's ultra convenient, it's ultra safe, key cards, CCTV, concierge. It's convenient in terms of being next to the university, so the locations are phenomenal. So no, long walks late at night, etc., etc. For those 2 reasons are the main ones why it's become so popular with overseas residents, just because the parents are aware of the security. It's all very transparent in what they've got to pay, often professional landlords in terms of companies as well. So there's plenty of advantages, but yeah, it's been certainly something that's going to continue to grow in my opinion. Now, from an investor's perspective, the model itself, they generate very, very high rental yields, namely just because the price they pay in relation to the low ticket value. So the entry levels can be from 60 to 90k, so 60 to 90,000 pounds in most cases, but the yields, net returns, even without contractual guaranteed rents, can be anything from 6, 7, 8%. So really, really strong opportunity for income generating focused investors. Now, we've seen big names such as Savills, Knight Frank publish data on the asset class consistently. So I suggest you Google Savills Student Accommodation Investment or Knight Frank Student Accommodation Investment Report, things like that. They often refer to it as the best performing asset class or investment class in the UK. And all you have to look at is the amount of institutional level capital that is being deployed into this investment class. So you're talking billions a year. Massive funds from the Middle East and Far East that are coming in because they recognise it's such an in-demand asset. Universities are not going anywhere, despite them evolving slightly, and it's just a safe, secure way to generate a strong yield, which is perhaps less vulnerable to market conditions, where residential property might go up and down a bit more. Student accommodation is typically linked to the yield it produces, so it makes for a really promising investment. That's enough for now, but let's quickly go on the bullet point pros and cons, and we can talk through if it's something that may potentially interest our investors. So first one, at an entry level retail investor level, i.e. someone buying 1 or 2 properties, then the point they have to think about firstly is you don't have to pay any stamp duty. So it's classified as non-residential. So below 125k, there will be no stamp duty costs. Secondly, high yields. So I've touched on this already, but you can achieve 7, 8, 9% net from a rental assurance provided by a developer, which means that you're immediately getting a higher yield than you would from a residential property. And what you've often see advertised, and I'm sure a lot of our listeners would have seen on the likes of Facebook or Google, is promised of fixed returns for 3 to 5 year periods. So it is true, if you do buy off plan, and i.e. during the construction period, and you secure a deal with a developer, you can get a fixed return. For example, we've had some recently where they've offered 9% net assured return for a 5-year period. Now, there are pros and cons to this and a lot to think about after the rental assurance period. Doesn't automatically mean it's a good investment just because it's got a fixed return for a couple of years. So there are bits and bobs to think about. However, certainly there are genuine opportunities out there where you can get a really strong peace of mind and security and consistent income from a reputable developer. That's a big, big draw for many of our investors. We do market and sell a lot of PBSA. Now, third one is the demand subject. So like residential property in city centres, student accommodation does see significant demand. Now, what you're seeing good developments is Good advertisement for the properties firstly, so they do a lot of online spending to generate interest from overseas. They'll work with other agencies which advertise student accommodation, and they'll get a significant volume of bookings from people that never visit the property at all. Because it's set up with reputable companies, video tours, all the contracts are online, it's very transparent and very secure. So the people that are often paying for the accommodation, i.e. the parents, can all arrange this remotely from the likes of, Hong Kong, China, etc. So because of that, we see very, very strong demand for the purpose-built student units. Now, also, as well as that, often the management firms will partner with the universities themselves. So again, looking at a recent example of us, we had an expression of intent from Liverpool University for one of our developers saying that they will happily recommend students. They recognise the quality of the development. They recognise the security benefit, etc., etc. So in other words, what we're doing is we're teeing up lots of students in advance from remotely, from overseas. We'll then do all the viewings when the building's complete and get people in. We'll then get group bookings and referral fees, and then we'll get direct recommendations from the university. So over time, you can see how the demand is through the roof for such properties. And moving on to the last main advantage is the fact it's fully managed and it's a hands-off investment. So especially if you have a rental assurance, it will be very, very stress-free. You won't be being called about any maintenance issues. You will simply have the funds paid into your account every 3 months, the same amount for the set period of the rental assurance. So it's all taken care of for you, and that will go for after the rental assurance period as well. Okay, so quickly we'll run through the cons, or a couple of the bits to think about when investing in student accommodation. Firstly, you cannot use mortgages. Now this is the biggest one which puts people off. So you do have to buy these assets with cash. Over it's 70, 80, 90, 100 grand. You need to pay for these outright. So that does restrict a lot of the market. As a result of that, what you'll find is the resale market is a bit more limited. So when you come to sell your property, you can only sell to another cash investor. Now, don't get me wrong, if you've got a quality student development in the middle of Liverpool, Manchester, which is doing over a 7% net return, you will see significant demand for that property because you've got a track record of occupancy rates, you've got a track record of rental income. It's just a very low risk investment. So you will see demand there. But when you start buying low quality student accommodation for 50 grand or whatever in Hull, Bradford, that's when investors can come unstuck and can sometimes struggle to shift the unit. So you do have to remember that you can only buy these properties with cash, and the resale market is a bit more niche. And just as a final one, in general, the capital growth and the appreciation on such properties is a bit more limited to in comparison to residential property. So that's something that we're transparent with everyone. It's primarily focused on people that want strong income rather than appreciation. If capital growth and building equity in a property is your key objective, we'll show you residential developments that would be better suited to your objectives and your strategy. So yeah, that's the pros and cons of student accommodation. As I touched on, this is going to suit someone that's very, very focused on income. They want a safe yield that they can hold for 10, 15 years. We always encourage medium to long-term holds with student because that's where your gains are made. And it's for someone that doesn't want any stress. They don't want to worry about stamp duty, furniture packs. They don't want phone calls every 5 minutes, etc., etc. So it really caters to, perhaps overseas or remote investors, or even investors that have significant buy-to-let portfolios already. By getting a student accommodation, adding some diversification, getting a high yield, that should really, really complement existing portfolios. So yeah, that's the lot for today then. We'll leave that there for now. So we went over HMOs, houses of multiple occupancy, short let, serviced accommodation, flipping and quick profit strategies, and then finally we finished off with purpose-built student accommodation. So next week, as I mentioned previously, we'll quickly recap on these ones, but then we'll go over 3 or 4 more really, really interesting ones with different levels of deposit and funds required. So for those that are looking for maybe a more restricted budget strategy, i.e. spending less, there could be some really interesting ones in store for next week. But that's a lot for today.
Yeah, that's great. So yeah, we'll see you next week for part 2. We'll see you then. Bye-bye.
Thanks, guys. Bye-bye.